18.3, let's talk a little bit about capital stock. So we're going to learn how to journalize transactions related to equity financing. A corporation may elect to raise capital by selling stock. Obtaining capital by issuing stock in a corporation is called equity financing. Selling stock increases the stockholders' equity in the business. An advantage to selling stock is that capital becomes part of the corporation's permanent capital. Permanent capital does not have to be returned to stockholders as long as the business continues to operate. Another advantage is that dividends do not have to be paid to stockholders unless the earnings are sufficient to warrant such payments. A disadvantage of selling more stock is that the ownership is spread out over more shares and more owners. Shares of stock are often assigned a value. A value assigned to a share of stock is called the par value. The par value has nothing to do with the market value of the stock. State laws use the par value to determine the minimum amount of equity that must be retained in the corporation. The date on which a business issues a note is called a bond or a stock is called the issue date. The issue date is required to determine the proper payments of interest or dividends. First example, on February 25th, sold 10,000 shares of $10 par value common stock at par value, $100,000, receipt number 16. What do we do with this? Well, our cash account is affected, as is our common stock, capital stock common. We pull out our cash receipts journal and write in our account title with our receipt number. A credit of $100,000 par value of issued stock, and cash is received at that point. So over time, the common stock of a profitable corporation will increase in value. Investors will be willing to pay more than the par value of the stock. And then we have excess of par value. So on August 4th, sold 600 shares of $10 par value common stock at $40 per share. So we're selling it for more than its par value. $24,000, receipt number 811. So our cash account is affected, as is our capital stock common. Paid in capital in excess of par common. So $18,000 plus $6,000 is $24,000. Our cash receipts journal, we list the capital stock common, receipt number 811. Paid in capital excess of par common, $18,000, for a total of $24,000 received. Issuing preferred stock at par value. So preferred stock is a class of stock that gives preferred shareholders preference over common shareholders in dividends along with other rights. Common stock is too risky for some investors. Preferred stock is typically described by referring to the stock's dividend rate and par value. On August 16th, we issued 400 shares of 6%, $50 par value preferred stock at par value of $20,000. So our cash is affected, our capital stock preferred is affected, and we need to write it into our cash receipts journal. Our account title, credit, the general credit, par value of issued stock, and then we received cash for that. Now, preferred stock. Corporations are not required to pay dividends on stock, whether it's common or preferred. But when dividends are paid, preferred stockholders get paid first. Preferred stockholders can have other preferences over common stockholders. So unpaid dividends may accumulate from one year to another. These dividends must be paid before common stockholders receive any dividends. The preferred stockholders get them first. If the corporation is dissolved, preferred stockholders receive cash for their stock before any cash is distributed to common stockholders. Preferred stockholders do not have the same voting rights as common stockholders, so that's a disadvantage of preferred stockholders. And that is it for this section. So, is a corporation required to issue dividends? No, they don't require them. If earnings are sufficient to warrant payments, they may reward the stockholders, but most of the time corporations use what they earn to put it back into the company, to grow the company. How is preferred stock typically described? By the dividend rate and par value. In what order is cash paid to preferred and common stockholders if a corporation is dissolved? The preferred stockholders get paid first, and then the common stockholders. What is the most common reason that investors purchase preferred stock? To earn dividends. Preferred stockholders are less risky, so they will get their dividends. And that's it. Easy one.